Greetings to the Honorable Board of Examiners, the esteemed Professor Dr. Eduardo Standalin, MBA, as my thesis advisor, and my fellow colleagues. Allow me to introduce myself. I am Muhammad Rizky Brian Edi Noerrahman from International MBA Batch 75. Thank you for sharing your time as I present to you my thesis titled Implementation of Data Science Techniques in Portfolio Management. Coming from a background of data science, the realm of finance, specifically the stocks markets, were especially interesting to me. The abundance of data being created every second means that there's always new potential to be tapped into with tools and techniques from data science. This study was also an opportunity for me to use my experience to tackle real-life problems. One of the questions that really caught my mind was how we can create optimal stocks portfolios using techniques from data science, thus helping our decisions become more empirical and data-driven. Nonetheless, before we can create optimal portfolios, we have to understand what are the challenges in managing portfolios. Portfolio management can be separated into three main stages: portfolio construction, portfolio optimization, and portfolio assessment. Portfolio construction is selecting potential assets. Portfolio optimization is finding the right weights or proportion of the assets. And assessment is checking the outlook of the portfolio. This study proposed a different set of tools and techniques for each stage of the portfolio management. Each technique was compared and evaluated to produce a select set of techniques, with the aim that these techniques can help individual investors, investment managers, and alike to create more optimal portfolios. The study also aims to contribute to the quantitative finance and financial data science fields in providing insight into these techniques and their implementations. The framework of the study is divided into the same stages of portfolio management. We will look at these techniques briefly now and discuss them later in the presentation. First, for portfolio construction. To group the stocks into portfolios, two different methods of clustering analysis were implemented. One is k-means clustering and the other is hierarchical clustering. But more data is needed to be extracted before. This is where feature engineering comes in. Next, the study also tested two different approaches of portfolio optimization based on two different theories. A more classical approach, mean variance optimization, proposed by Harry Markowitz in 1952, and a more recent approach, hierarchical parity risk, proposed by Marcos Lopez Prado in 2016. Given that the study was implemented fully using the Python programming language, a lot of the calculations, analysis, and data collection were done with the help of Python libraries such as Pandas, scikit-learn, and more. The first phase of the study was to collect the data and create more data from the collected data. In data science terms, this is called feature engineering. For the data collection, InvestBuy and Y Finance helped tremendously by downloading this data from Yahoo Finance and investing.com, compiling them into Pandas data frame, ready for the next phase. The data used in this study were a selected set of stocks that have been in Compass 100 for more than 10 years. This amounted to 52 stocks. Additionally, Compass 100 composite price, 1-year Indonesian government bond yield, and financial summaries of the companies were also collected. More features were extracted from the said data, starting with daily returns, daily risk premiums, and daily market premiums. But it didn't stop there. More features such as volatility, Sharpe ratio, alpha, beta, and information ratio were further extracted from the data. This is the feature engineering phase. Using data created previously, clustering analysis was used to group the stocks and construct portfolios. For k-means, data can be inputted directly, but to reduce computation, we chose features that correlate highly with realized returns. K-means searches for the center of each cluster by minimizing the within cluster variance, while for hierarchical clustering, we transform the whole data into a distance matrix as required, so it can be processed by the algorithm. The clustering algorithm analyzes the hierarchical tree structure of the data, and clusters are formed from these hierarchical groups. To implement the clustering analysis, we need to figure out the ideal number of clusters. In K-means, we look at the sum squared errors and the number of clusters plot to infer where error is no longer significantly reduced. For hierarchical clustering, we look at the hierarchical tree diagram. Then we can create a cut on the hierarchical structure and group all the nodes below this cut as clusters. Once we have these portfolios, from the clustering analysis, we have to assign them weights or ratios within the portfolios. A naive approach to this would be assigning them equal weights, but most of the time this isn't always optimal. So we use two different optimizations, mean variance optimization and hierarchical risk parity. For mean variance optimization, it was introduced by Harry Markowitz in 1952 and became the main building block of modern portfolio theory. Here, mean variance optimization was implemented using the Monte Carlo method, where 50,000 of randomly weighted portfolios were generated for each portfolio created in the previous stage. Then we seek the mean variance optimized portfolio by finding the portfolio with the highest Sharpe ratio in the efficient frontier. A more recent approach to portfolio weights allocation is hierarchical risk parity. Marcos Lopez de Prado combined clustering algorithm with graph theory in assigning the weights. Hierarchical risk parity involves looking at the hierarchical structure of the stocks instead of expected values, where the hierarchical structure of the data is inferred from the data's distance matrix. This is so that weights can be allocated along the hierarchical structure. Here are some examples on how the optimizations work. With this, we can start to test which techniques can be implemented to create optimal portfolios. To do this, the data was split into training and validation sets. To assess the portfolios created from the previous techniques were tested on future data compared to portfolios with randomly selected stocks and evaluated against the market. First, we tested the method on a set of training data from 2010 to 2020 to find which cluster and which optimization can create the most optimal portfolios. From the training, we deduced that clusters with the highest average alpha within the cluster outperform all the other clusters. The random portfolios and the market were also significantly outperformed by these optimal clusters. So we call this the optimal clusters. Here, the optimal clusters, even with naive or equal weights, can outperform all the other portfolios. Looking at the two optimizations, we found that mean variance optimization was unstable and can give varying results. This was already a problem discussed by Michaud in 1989, and this is actually one of the reasons why Marcos Lopez de Prado developed hierarchical risk parity in 2016. On the other hand, hierarchical risk parity was proven to be a robust optimization method, where the portfolios optimized using this significantly outperform the market and randomly constructed portfolios. Looking at the portfolios from both of the clustering techniques, both of them perform almost the same on this test data. Therefore, both of them were used for portfolio construction on validation data. Now, moving on, validating the model on a new set of data from 2010 to 2021, where the portfolios are tested for 2020 to 2021. The portfolios from clustering combined with hierarchical risk parity have outperformed the randomly selected portfolios and the market significantly, up to 63% gain in holding return and 37% gain in cumulative return. The risk-adjusted returns, such as Sharpe ratios, are also above 0.6, while the sorting ratios are around 1. The breakdown of the portfolios are shown here. K-means has picked up less stocks than hierarchical clustering, and the hierarchical risk parity puts a large ratio of the portfolio on a single stock. The main conclusions from this study are the techniques proposed have aided each step of portfolio management and allowed decision making on these stages to be more data driven. Optimal portfolios can be created through these techniques. Hierarchical risk parity performs better than mean variance optimization. The results also happen to support Michaud from 1989 and Lopez de Prado from 2016 and their findings on how mean variance optimization can be unstable and deviates from the optimal portfolio when expected returns and/or volatility was skewed. For future reference, some of the recommendations that we can provide are: due to limited computing resources, the study was limited to a small data size. And for a more comprehensive study, all the stocks from a market such as IDX should be considered. More portfolio optimization methods are also available. Some are also already built into the portfolio management libraries on Python, such as Pyfolio. Portfolios can be held for shorter periods of time as well, instead of 2 years, like in the study, but model must be adjusted accordingly. So that's all from me. Thank you very much.